Hey, good morning, options traders, and a big welcome to all of the new traders that we've had here recently. And I wanted to run something past most of our traders because I think people are confusing a profit and loss diagram versus a payoff diagram. And that's because I've been hearing people saying, well, why is it on a profit and loss diagram we're not seeing the full intrinsic value? So let's talk about that. Let's look at our profit and loss diagrams and see how to identify the intrinsic versus the extrinsic value. So first, quick refresher, what is intrinsic value? We can think of it as the cash value if you exercise the option now. So let's say that the stock is at 102, the $100 call is trading for $5. Well, if you exercised the call right now, you would be spending the $100 strike and receiving stock worth 102. And so that would give you a real $2 benefit at that moment. But notice that the option is trading for 5. So if the option is 5 and there's $2 of intrinsic value, then the remaining $3 must be the extrinsic value or the time value. And it's this extrinsic value here in red that is going to bleed away from the passage of time. And that just simply means that if the stock is still at 102 at expiration, this option's price is going to fall from 5 down to 2, just to the intrinsic value. So for a little more of a detailed definition, for intrinsic value, for your call options, it means the strike price is less than the current stock price. So in the last example, we saw the $100 call with the stock at 102. For put options, it's just the opposite. The strike is greater than the current stock price. So if the stock is 102, we might need to see the 103, 104, 105 strikes. Any strike above 102 would be an in-the-money put option. So why does this cause so much confusion when traders are looking at profit and loss diagrams? Well, it really comes down to there are two types of diagrams that we'll use. One is called a payoff diagram, and then there is a profit and loss diagram. Now, what I pretty much show in all of my videos are profit and loss diagrams. It's what most of your broker platforms will show. But if you're looking at those, you're going to have a hard time seeing the intrinsic value. And here's why. Let's start with a payoff diagram. And let's say that the stock is 100 and the strike is 100. So we get our bend right here. And notice that I've drawn this so that this flattened portion right here on the graph lines up at 0. See, normally we have this line up at the price that we paid. So if I paid $5 for this call option, it would actually line up at -5. But in a payoff diagram, you can think of it as if we're paying nothing for the option. We're just trying to see what the total payoffs are outside of the option's cost. So in this example, if the stock is at 100 and let's say it rises to 110, we trace a line up to the black line, and right where it touches, we look left, and there's your $10 of intrinsic value, right? If you have the $100 call, stock's at 110, there is $10 of intrinsic value. On the other hand, if we start at 100 and the stock rises to, let's say, 120, now we trace a line straight up to the black line, we look left, and there's $20 of intrinsic value. So see, when it's drawn like this as a payoff diagram, there's no confusion. And that's because we are assuming that nothing has been paid for the option. We're just looking at the fact that it will be worth 0 at expiration if the stock is at 100 or below, or it is just worth the difference between the stock price and the strike. Very easy to see in a payoff diagram. Now, of course, prior to expiration, we don't just have this black line, we have the current curve. So if we drew this on a payoff diagram, it would look like this. Notice that the red curve is also starting to line up at 0. And as time goes by, this red line slowly starts to move towards the black. So let's say maybe 10 days later, another 10 days goes by, another 10 days, and we just keep slowly marching towards the black line until right at expiration we fall on the black line. So let's go back to the current curve, and let's say that our option is trading for $6. So if we look straight up here from the payoff diagram, yes, we line up at 6. If the stock rises to 110, the pricing model might say that the option is worth $12.43. And if we do that, we can see very clearly that there is $10 of intrinsic value. That's what we just saw. And then this additional space right here between the black and the red line, must be the additional 243. So 10 plus 243 gives us this total distance of 1243. If the stock rises out here to 120, the pricing model might say that the option is worth $20.85. So again, we can see that the intrinsic value is this distance, so that would be 20, and then this little tiny, you can almost barely see it, that little tiny space between the black and the red is just 85 cents. So if we add the intrinsic to the extrinsic, we get $20.85. So the main point from this is that if you're having a hard time seeing the intrinsic value and the extrinsic values, it's because you're not looking at a payoff diagram. Most of your broker platforms are not going to show it this way. Instead, they're going to show it as a profit and loss diagram, and this is where the confusion can come in. So let's say that we buy a $100 call. We'll use that price as 6, and we have to remember that you've got to subtract this $6 cost to make sense of the profit and loss diagram. So let's use the exact diagram that we saw, but now we're going to shift it down. See, notice how we're no longer lining up here at 0. I've now shifted this portion down to line up at -6. And the red line again is the current curve. So here's our 0 line right there. Let's say that the stock rises from 100 to 110, which is what we saw before. We saw before that the option, let's say, would be worth $12.43. So we know that the option is worth $12.43 here at 110, but notice we have to account for this $6 of a cost first, just to get us back up to 0. So everything above this line is now just $6.43. So see, it looks like we're saying that the option is worth $6.43, but remember, this is a profit and loss diagram. The option is not worth $6.43, it's worth $12.43. Your profit is $6.43 because we had to pay 6. So that's why there is a confusion. Now, if we look at the distance between 110 and the black line right here, on a payoff diagram, we saw that that was 10. But see, now we're seeing that it's only 4. So again, this is where traders get confused, and they go, why is there only $4 of intrinsic value? There's not. This is a profit and loss diagram. There's $10 of intrinsic value, but we've got to subtract out the $6 cost, and that's what's showing us $4 of profit based on intrinsic value. But this remaining little gap right here must be $2.43. So I've got $4 of intrinsic value in terms of profit, and I've got $2.43 of profit in terms of extrinsic value. But again, you cannot confuse that to think that the option's total price is $6.43. This is a profit and loss diagram, and it's simply subtracting out the option's price that you paid. So I hope that clarifies it. I've had some people asking about that and saying, again, in this case, why am I not seeing $10 of intrinsic value? You are, once you realize that you have to subtract out the price you paid. So I hope that helps to clarify it. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. You can find it all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.